All right, this is what we've been waiting for. Exciting news on the horizon. Interest rates are on the move and they are headed down. In the past several days, we've seen a significant decline in the 10-year treasury yields below 4.20, and mortgage rates have been trending downwards. Major banks are forecasting successive rate cuts, not hikes, and even the Federal Reserve's own dot plot indicates that rates will continue to drop. This is a game changer for everyone with credit card debt, recent home buyers, and those that are considering a home purchase that have felt priced out of the market due to the high mortgage rates might find new opportunities as rates continue to fall. If you've been burdened by the rising HELOC rates due to the increase in prime, this news couldn't come at a better time. But while this all sounds like a win, remember the old saying, nothing is free. Every economic decision has its costs. What are the potential repercussions of these rate cuts? What might we have to give up in exchange for these lower rates? What does the Fed and the big money see on the horizon that we don't? Today's topic, a bombshell that has rocked the financial world. Citi's shocking forecast of 8 successive rate cuts. But hold on a second. Before you start celebrating, there's more that you need to know. Is this really a bullish signal for stocks and real estate? What typically happens when the rate lowering cycle begins? Is this a sign of a looming recession, or are we already in one? Welcome back to my channel. Please do me a favor and hit the like button and subscribe below for more information. So let's get after it. Many people might think rate cuts are bullish for stocks and real estate. After all, lower rates can mean cheaper borrowing costs and potentially more investment. But don't fall into that trap. History tells us a different story. First, we need to consider how these cuts will impact the broader financial landscape. When the Federal Reserve cuts rates, it often signals economic trouble ahead. Big money or smart money tends to move out of the stock market and into bonds when this happens. Why? Because the benefits of lowering interest rates are often outweighed by the damage of a weakening economy. Historically, rate cuts can lead to a bearish trend in equities and in real estate as investors seek a safe haven for their capital. This shift can cause stock prices to fall and real estate prices to fall, impacting anyone with investments in the market. A drop in the equity market does not necessarily mean that the economy is in a recession. However, it can be a leading indicator. Let's look at the data. The US and the rest of the world are in a deepening recession. Official numbers may not necessarily show that the US is in a recession, but look all around. Everything that you're looking at indicates and points towards an economic slowdown. In China, for example, the real estate market is in absolute shambles, and their real estate market is significantly bigger than the US. And many factories are sitting idle. Unemployment is rising, and automation is making it worse. We, as in the US, are not immune to this. Yes, we have absolutely had a robust residential real estate market defying what most people's expectations are. But what's not getting any attention really from anybody or the media specifically is the commercial real estate market. Commercial real estate values are plummeting. Commercial mortgages fraud is up significantly and continuing to rise. Commercial mortgage lending is drying up, and major commercial mortgages are on the rise as far as defaults. Commercial real estate is tied to the banking system, and the banking system is connected to the stock market, to real estate, and to everything else. What about automation? Just recently, Walmart decided that they're going to open up 5 automated distribution centers, and the unemployment rate is continuing to tick up. Citi's forecast of 8 consecutive rate cuts, reducing the Fed funds rate by 2 percentage points, is based on an economic slowdown. Major banks would not be forecasting such aggressive cuts if they weren't seeing the red flags. They emphasize rising unemployment and weak manufacturing data. Companies may face declining profits, leading to layoffs and reduced consumer spending, further slowing the economy. Another indicator, lumber prices are close to their lows. Think about last year. If you needed a contractor to get you a bid, you couldn't find one. Now they are in a hurry to get out and give you one. If lumber prices are low, that means that there's no demand. If there's no demand, that means there's less jobs in the construction industry. Again, another sign of possibly increasing unemployment. Remember Lehman Brothers back in September of 2008? Even one day prior to their bankruptcy, strategists were advising you to buy. It's a reminder that financial disasters can happen suddenly and unexpected. This is why you need to be prepared and stay informed. One positive aspect of a weak economy is that bond yields will likely decline sharply. This could lead to a rally in the bond market, reducing the huge losses we've seen since 2020. The Fed will soon shift its focus from fighting inflation to addressing economic weakness. This pivot reflects a significant change in priorities as central banks move from combating rising prices to mitigating the effects of a slowing economy. While it's easy to point fingers at the political chaos in Washington, that's the easy scapegoat, blaming it for the current economic mess, the reality is much deeper and more complex. Over the past year, the Federal Reserve has been laser focused on controlling inflation, which soared to multi-decade highs. They've implemented aggressive interest rate hikes, hoping to cool down an overheated economy. However, these measures come with side effects. Higher borrowing costs can stifle business investment and consumer spending, both of which are crucial for economic growth. That goes without saying. Meanwhile, the political scene in Washington has been anything but stable. Partisan gridlock, frequent policy shifts, and high-profile disputes have created an environment of uncertainty. It's tempting to attribute the economic challenges solely to this political turmoil. After all, constant wrangling over budgets, debt ceilings, and regulatory changes can disrupt financial markets and erode business confidence. But the issue runs deeper. We're also dealing with global economic forces that are beyond the control of any single government. For example, supply chain disruptions, trade tensions, and still the lingering effects of the COVID-19 pandemic have played a significant role in shaping the current economic landscape. Additionally, problems like income equality, automation, and shifts in the labor market contribute to the economic instability. It is not just political. The Fed's impending shift in focus from inflation to economic weakness highlights the delicate balancing act they must perform. On one hand, they need to ensure that inflation doesn't spiral out of control again. On the other hand, they must provide enough support to an economy that's showing signs of strain. This dual mandate to promote maximum employment and stable prices is tough, especially in today's interconnected and fast-evolving global economy. So, what do we do as real estate investors? Here are 3 takeaways. First, be cautious and watch your liquid investments you use for down payments, cash purchases, or renovations. A recession can hit harder than the benefits of lowering interest rates, which could eat away at your liquidity if invested in equities. Number 2, emphasize cash flow over appreciation. Everybody still needs a place to live, but cash flow will be the most important when making investment decisions. Even with the higher interest rates in today's market, cash flow remains king. There are plenty of strategies out there that will help you cash flow all your investment properties. Third, stay informed. Do not rely solely on the mainstream media. Dig deeper and understand the underlying economic conditions. We're entering a complex financial landscape. While the media might not highlight it, seasoned investors know that rate cuts are often a sign of trouble ahead. If you found this video helpful, please do me a favor, hit the like button, subscribe to my channel. Also, share your thoughts in the comments below. What do you think about Citi's forecast? Do you agree with my analysis? Let's get the discussion started. My name is Darren Hunter, and this was another guaranteed video. Look forward to seeing you on the next one.